Good day, everybody. It's Greg Schnell, and I am here with one of the things that I think influenced the market the most in 2021. We'll find out how it all plays out, but I think it's got a pretty good shot at being one of the biggest issues in 2021. So what I'm going to go through is what I like to call the roaring 20s. We've had quite a move in the stock market so far, both in 2020 and 2021. So we're off to a good start for the name the roaring 20s. But the big thing I want to discuss here is the volume. And the thing I want to notice on this was back in September 2019, we were averaging in around 40 billion shares a month trading on the Nasdaq. That's not a big deal. But more importantly, what happened when COVID hit, the volume accelerated. And part of it was just selling by institutions. But then we also got into the people working from home and they were trading from home. And we moved up to around 80 to 100 billion shares. And then in January, February, March, we actually got up in around 140 billion shares a month. So 2.5 times the volume of where we were, another 100 billion shares on top of the 40 billion we were doing before. That is a staggering number, and that signifies something to me, that we're in a whole different world. We're in a big volume acceleration. And the point that I think is most important to remember here is it's pushed up meaningfully, but at the same time it could go on running for a long time, right? We all think that way, and I think that's pretty important. But we have a couple of good precedents that happened in the 2020s, or the century 2000. And what I'm thinking about here is in 1997, 98, 99, we had a steady build of volume, and that was growing very actively. And as volume accelerated, and then all of a sudden we saw this huge super surge in 1999, and then it took until I'll call it early 2020. And what happened in the second part of 2020, and I think this is particularly important, is this second volume surge that came in, and that kind of marked the end of that euphoric bubble, and we rolled over. So one of the things that we see on the chart today is we've had this huge bubble, and we've had a little bit of volume showing up in November. And remember, November has a day and a half of vacation in there around Thanksgiving. So that was pretty meaningful volume if you take that out or add that back in. And then the second component of that is we also have a PPO sell signal. Now we're early in December. This is December 17th. We've got some short trading days ahead around the Christmas and New Year's period. So what we want to talk about here is just being aware that we're already on a sell signal for the first time since the COVID lows. And again, we have to wait for another 7 trading days or whatever to go by. But the big thing to be aware of is this rollover could be pretty important as a clue to what's changing. So that's one of the things I want to focus on. So in 2021, we also had a big change in the number of stocks active in the market. And so mid-20, we kind of had this gentle uptrend going. And then also in 2020, 2021, we literally launched off the page. The New York stock market went up about, call it 15%. It was a pretty big rise. And then the Nasdaq went from 3,400 to 4,800, so 1,200 new shares, more than 33%, like just a massive surge in new stocks available for trading as the retail investor came in, and venture capitalists knew exactly what to do with that money, was to give them something to buy and dreams to start to invest in. So where are we now? I've drawn this trend line ignoring COVID, because COVID wasn't really a market event. It was more a health event, and as we pulled back the market, everything changed, and obviously the stock market responded to that. And governments worldwide kind of jumped on the bandwagon to try and keep things on an even keel. So if we go back to the 2018 low, and you'll just notice that we have a pretty close touch here, a touch here, we broke through it here. We started to find support in around this, I'll call it trend line, in the June-July period in 2020, then in October 2020, and then in March, coming out of the huge surge we saw, and then in May we were well away from this line, but back in September we touched it again, and now here we are. We found ourselves in late November, December, touching this line 3 times in the last 4 weeks. So, or sorry, in the last 3 weeks. So it's been in play, but I think it's becoming more in play. All of a sudden it's becoming much more common after we stayed away for a long period of time. And there's also 2 distinct moments in this chart. One is when the vaccines were announced, and the other was the top of the SPAC movement where everybody was throwing money at the market. And one thing that we see during that SPAC movement is really high volume. And so a lot of stocks sold off in that moment. And one of the big things to think about when that happens is that's a change, right? That's a change of behavior where we had this euphoric run up, and now all of a sudden the people are pulling back from the market, and they're also losing a lot of money. And then what we're seeing now is basically since September, we've actually started to see volumes rising. We've had quite a few months above the April, May, June, July period, or quite a few weeks above that. And so as that's starting to show up, we also see negative momentum hitting on our PPO indicator. For those not aware, that's kind of like the MACD, but it uses percentages instead. So this has been declining for a while. It's making new lower lows, and the stock market is sitting right on this important trend line. I don't know if it breaks tomorrow. I don't know if it breaks in a couple of weeks. More importantly, I think, is that we're losing a lot of momentum. We've had a huge amount of speculative volume. We're starting to see a bit of blow-off volume at the end of this, and we're starting to see things coming back to the trend line. So it all makes it a pretty important place to watch. The 40-week moving average is sitting down here at 14.6 for the Nasdaq, and we're just trading above 15.1. And many people will say, you know, it's only the Nasdaq 100s that's important, and that is true. But in general, we got some bigger picture issues to deal with. So when did the Nasdaq actually top in terms of overall breadth? During this SPAC period, it was very, very high, and that's when our advanced decline line topped. And it's been pretty much declining all year now. We're well below where we were in January. And I think that's representing a big change for us, that we need to understand that each week we're losing more and more participation in the market, trying to push things higher. So when you have an entire football team trying to take the ball down the field, that's pretty important. When you only have a third or a quarter of the football team working to take the ball down the field, it's a lot less helpful. And so we've got a lot of drag in the system now, and what we really need to figure out is, can we work through that? So if we just assume that this is all, I'll call it excess volume or new volume, one of the things that happened back in the year 2000 is we never did revert back to the lower levels of volume that we had seen before that. We kind of stayed at a high level. While I expect we might do that, I think we might stay closer to this 20 billion a week level, which would put us around 80 billion. But this 140 billion month that we had in January and February, we're pretty much off the charts, and so we're back down to a lower level, but we're still elevated. We're still tracking around 100 billion barrels, 100, can you tell I'm an oil guy, 100 billion shares a month trading lately. So we're back to some elevated levels, and you can see that on the chart here. So what do you mean you don't believe in bubbles? And this is a subtle tweak from the famous line in the Pirates of the Caribbean, because he was talking about, what do you mean you don't believe in ghost stories? And he said, well, you better start believing, because you're in one. I think we're at the same place. We're in a big bubble. It's hard to recognize it, but we've had global fiscal stimulus, global monetary stimulus. We've had governments literally writing checks for people to stay home. We've had probably as much euphoria as we can possibly handle, and the real trick is going to be climbing out of the hole on this one. So if we want to look at the stock market, just its average performance, what we see here is the lower line is when the price earnings ratio is 10, price earnings ratio is 15, price earnings ratio is 20. Well, we're currently tracking as of December 13th, when I created this chart, 29 times earnings. So we're literally what I call the logarithmic moonshot. We're 50% above the level that would be considered kind of an extreme level. So again, let's not even go with the lower levels or the mid level. Let's go with the high level. There's not very often that we spend this much time above the red line, and yet here we are a full 50% above. So we are in some sort of pretty heady state. So when you draw the price earnings compared to the S&P 500, in 1999, we kind of hit the peak before the stock market topped out and rolled back down. And then after the stock market kind of collapses, you end up having a price earnings surge. And then the same thing in 2009, we had a price earnings surge. Well, in 2020, we've had this big surge, and now we're coming off the second level here. So we're kind of right about here, using the price earnings chart to help guide us. But no question about it, we're a long way above. And we're as far above as we were in the height of the 2000 bubble, and we're not quite as far above, 2007 was nowhere near this level of extreme. So pretty significant place on the chart. Okay, now what this chart is, this is a chart of some of the big stocks that moved out of the COVID lows back in 2020. So if you bought these stocks on April the 1st, how they performed, so that would have been a week after COVID, so you would have really had conviction. A very difficult time to buy, but if you did, you saw some really great runs in stocks, and we saw Nikola take off and do a super surge of almost 600% and literally turn and reverse that. And now here we sit in December 2021, and it's the worst stock out of the whole group. So quite a different complexion. But we also see a couple of other things on the chart, and that is that the majority of the stocks rose into the February highs that were created somewhat on the back of the SPAC bubble. But we also had the vaccines come out in November, which really caused an acceleration in almost everything. So these were some pretty heady names, but I think the important thing to remember is, don't get me wrong, they had a big surge, but you had to buy them on the right day. Anyway, most of them are still up meaningfully, like 220, 140, 100, 60, 20%. So they're okay, but the bigger issue is if you divide that by 2 for 2 years, because we're 2 years into this pandemic, they've really lost some of their luster because the market was up a lot in that period as well. So here we are just looking at the same stocks, but looking at it from the period when the new vaccines were announced. And that was November 2020, and things just shot up to the moon, and you can see basically everything rose into the SPAC bubble, and then everything pretty much has been downgrading since there. There was a couple of stocks that were able to hold up a little bit, and the list of stocks is Square, Ballard Power, Zoom, DocuSign, Peloton, Nikola, Space, Roku, PayPal, and ARK Investments. So of that, 6 of them are below zero, and only 4 of them are above zero with a 10% return for the last year, whereas the S&P 500 did over 25%. So this is quite a substantial underperformance by the names that at one time were considered pretty good. So now I want to cover off the big 6 stocks. What I want to cover off there is Amazon. This is the kind of the best trend line on the chart I could find for it, but it really did a super surge, a doubling on the back of the COVID lows, and then really hasn't done anything since then. But this is kind of a big general uptrend for Amazon, and maybe it's ready for its next leg higher. It is involved in cloud computing, but you'll notice that there's not a lot of momentum down here showing up. I've placed these big six stocks in order. Oh, this says Microsoft at the top. Sorry, this is Amazon. Revenues of 386 and a price earnings ratio of 66. Apple, what we see here is the big uptrend off the 2018 lows. That trend is still intact. Revenues of 365 and a price earnings ratio of 30. But you're starting to see some volume coming in here. And again, we want to watch to see if volume comes in, kind of marking the end of the runs. Google can't really point to any sort of volume breakout here, but what we're seeing is the stock has definitely broken the upsloping trend line, but it's a lot steeper than all the other trend lines. So to me, it still looks strong, nothing to worry about, but revenue of 235 billion and PE of 27. So these are pretty heady levels for big companies to maintain such a high PE. Microsoft revenue is less than half of what it would be for Amazon or Apple, and yet price earnings ratio of 36, and this is just a super chart, just beautiful. But we do see a volume acceleration on this chart. When we get into Facebook or Meta platforms, what we see here is this stock has still trending up, but it actually cracked the trend line over the last couple of weeks, and we're trying to see if it will hold. But you'll also notice the volume is accelerating meaningfully as we get towards this. So since September, the volume's really picked up, and we're starting to see it testing zero on the PPO. We really don't want to see it start to go below that. Lastly, we have Tesla with revenues of 31 billion and price earnings ratio of 302. And what we see there is a really high PE ratio for a $1 trillion stock. And this uptrend cracked for the first time on this week of December 10th, so or December 17th. So anyway, we're seeing the stock roll over here. It was down 8% on the week. We've got a PPO sell signal. First time since we got a sell signal back in January, February, where it topped out. A pretty important place on the chart for Tesla. So two of those are getting kind of weak, and the other four still look okay. Commodities, I think they're pretty important, and they tell us a clue about what else is going on in the world. The big thing that we had was commodities have made this beautiful run up off the COVID lows and are now looking almost like they're topping out here, and have broken the trend line. Meaningful PPO sell signal, and this chart's making lower lows in momentum all of a sudden. So it's been quite a switch for us on the commodities. Crude oil has done the same thing. It's broken the big uptrend, and now it's been sitting around the trend line, but also around the 40-week moving average. It's getting right down near zero here. And my backdrop on the oil area of the market is that I would expect it to be going quite a bit higher. But if overall something's going to crack in this market, it's a pretty important place to be aware of. So next, moving on to the bonds, what I want to show here is a couple of things. There's a trend line on the bonds like there is on the equity market, like there is on the commodity markets. A pretty important trend line, and we're starting to play with it quite a bit here. The last 3 weeks we've dipped down to that level. And our PPO is breaking its momentum line, suggesting that yields are going to go down, prices of bonds up, which is usually kind of a defensive posture for investors. This top chart is the 10-year minus the 2-year yield, and what that does is gives us what we call a spread. Well, one of the things that's important to notice is the spread chart kind of mimics what happens on the banking chart by about 2 months. So you can just see it made a low here and the banks made a low 2 months later. It made a high here, the banks made a high 2 months later, a low, and a high, and a high. So what I'm wondering about now is, are the banks about to break down? Because this yield looks like it's breaking its trend line, and this is a daily chart, not a weekly, but it's pretty important to just be aware that this looks set up to go lower for me for the banks. So I want to be very aware of that. Now, so I rushed through those a little bit, but I want to just kind of spend a few minutes focusing on some of the more important industries, and one of them is the banking industry. And what we see here is the momentum on the banking industry has actually made a lower, has made a low and now a lower high, very close to zero here, and this looks like it's losing all of its upward momentum. So again, we have all the conditions for a bubble. The real question is the bubble going to pop? And so I would just say that this chart has broken this trend line for about 3 or 4 weeks now, and is sitting here at the 40-week moving average, kind of an important place to watch on the chart. Don't really like it when the bankers get below the 40-week. And then the PPO momentum rolling over with a lot higher high in price, but a lower high in the momentum, signifying a negative divergence and a weakness in the chart. When we go look at cloud computing, it's been one of the big areas of high-tech growth. And I would just say, going back to the 2018 trend line, and you run that trend line up, we're starting to dangle below that trend line for 3 weeks now here. And really, we haven't done that anywhere, a little bit in October of 2019. But even the COVID low was pretty brief dip below here. But now we've been running up at a pretty high level. Now we're actually living below the 40-week moving average, which I think is a real trend change on such an important group. And we see a lot lower high on the PPO momentum and almost going below zero here, which is quite a change. So we need to watch that cloud computing chart and just see if it can hold the trend here. But I would think if these industries I've laid out start to break trend, it's pretty important. Renewable energy, here's another one. This is kind of where everybody's been focused with all the electric car business going on and the self-driving cars and a lot of the autonomous technologies that Kathy Woods has been investing in. But what we see here is, going back to that 2018 low, we're breaking the trend line for the first time this week, which I think is pretty meaningful. And again, we've got a sell signal on the PPO, and this uptrend in momentum, it wouldn't take much to kind of spill below that very quickly, suggesting the run is over for now. And I've got software. Software is just a beautiful chart. That's just an uptrend. It looks like Microsoft just continues to run higher as a group, so that's pretty special. I would say that my PPO trend line is being tested this week, so if we don't get a good bounce here, that would be an important clue that the momentum level is changing on software. And it did had a rough week with the market down a little bit. This was down 5%, so almost double what the S&P was. And I think at the end of this week, it was the Nasdaq down 3 and the S&P down 2. So this was kind of falling faster than we'd like to see. So anyway, this trend line is going to be tested over the next couple of weeks. We'd like to see that hold. I think that's pretty important. Semiconductors, what's going on here? They've had a great run, and recently they just had a huge run, 4, 5, 6 weeks coming out of October. Ran up nicely, but volume accelerated meaningfully, and you can just see, we've had a lot of volume up here, call it around 125 billion shares traded in this area. And if we look left on the chart, there's July and a little bit in late July, early August were the only times we saw volumes up at that level. So something's definitely changing for this software and semiconductor area that we need to be aware of. And again, PPO momentum rolling over, but hasn't given us a sell signal. So I think one of the most important things is, if investors don't have a strategy to protect when the market changes, my suggestion would be to get some help with that in 2022. Because if these charts continue to roll over like they are looking, going across the different asset classes of commodities, equities, and bonds, it seems to me that it would be prudent to have a plan. So with that, happy holidays, and I wish you success for your trading in 2022. I think the single biggest, most influential market event was the blow-off in volume that we saw in February, and how that's changing the trends over time. Thanks for watching, and have a good week. Bye-bye.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.